Wall Street just watched $6.5 billion flood into a single ETF faster than anything in history. And the company at the center of it makes a product most people haven't thought about since buying a laptop in 2009. Let's start with the record breaker everyone is talking about. A DRAM-focused ETF recently pulled in $6.5 billion in assets faster than any ETF in history. The previous record was 43 days. This one crushed that. And when something moves that fast, you have to stop and ask why. Here is the core idea driving all of this. Memory chip companies like Micron were once considered purely cyclical businesses, boom and bust, driven by consumer electronics. Unpredictable. But something fundamental has changed, and it comes down to one thing: artificial intelligence. Just a few years ago, Micron was pulling roughly 15% of its revenue from data centers. Today, that number sits at around 65%. That is not a temporary spike. That is a structural transformation of an entire business model. And when earnings become more predictable and demand becomes persistent, the old narrative about cyclicality starts to fall apart completely. Now here's where it gets really interesting. While everyone is laser focused on the obvious AI plays, the smarter money is looking at how AI is pulling in industries that most people would never associate with technology. Think about copper. AI data centers are copper-hungry machines. They consume enormous amounts of it for wiring, cooling, and infrastructure. Unlike oil, where new deposits can be discovered relatively easily, most of the world's major copper deposits have already been found. So you have rising demand crashing into a constrained supply. That is a recipe for rising prices, and investors who spotted this early have been rewarded. Then there is power generation. Data centers need backup power, and companies supplying that equipment are seeing their revenue explode because of it. Even Caterpillar became an AI trade. Ford became an AI trade this week. The ripple effect of this technological build-out is touching everything. But here is the tension. Critics are calling some of this a mania. And honestly, the concern is not completely baseless. A 96% move in roughly a month on any investment is extreme. You have to acknowledge that, but extreme short-term moves do not automatically signal the end of a long-term theme. They often signal the beginning of wider market recognition. So what should you actually do with this information? First, understand that diversification within the AI theme is becoming more important than ever. 45% of the S&P 500 is now considered AI or AI adjacent. Second, look beyond the obvious semiconductor names and consider the infrastructure plays, the power companies, the materials suppliers. Third, remember that volatility is the price of admission for any meaningful long-term gain. Markets will always have risks: geopolitical uncertainty, macro headwinds, earnings disappointments. Those things are never going away. But history consistently shows that investors who stay focused on where real earnings growth is happening tend to outperform those who sit on the sidelines waiting for perfect conditions. The AI build-out is not a single trade. It is a multi-year transformation across dozens of industries. The question is not whether you should be paying attention. The question is whether you are looking in all the right places. If this video helped you see something new, hit like, subscribe, and stay tuned because we are just getting started. We encourage you to engage with this content by subscribing to our channel for more insights on these important topics. If you found this video informative, please give it a thumbs up and share it with friends and family who may also benefit from this information. Your support helps us continue to provide valuable content and fosters a community of informed viewers.